Hello friends, you must already know about market trends. Generally, there are three types of trends: uptrend, downtrend, and sideways trend. But here comes an important question. Does the market always move according to these trends? The answer is no. Many times you will notice that the market moves in a different way. Price is not creating clear higher highs and higher lows, nor is it making lower highs and lower lows. Instead, sometimes it creates at a high, sometimes a low, and sometimes it just moves within a range. So what should we do in such market conditions? The answer lies in understanding market phases. One thing you should always remember is that market never moves randomly. The market always moves through different phases, and if you understand these phases, the way you read the charts can completely change. In today's video, we will understand what are market phases, how many phases exist in the market, and most importantly, how you can use them to find trading opportunities. So make sure you watch this video until the end. Now let's first understand what a market phase actually is. Imagine the market is in a strong downtrend. Price is continuously moving lower and sellers are making good profits. But after some time, those sellers start feeling that it is the right moment to book profits. Remember, whenever sellers book profits, they need to close their sell positions. And closing a sell position means placing buy orders. As sellers start exiting their trades, buying pressure enters the market. At the same time, new sellers are not entering aggressively. As a result, bearish momentum starts slowing down, and instead of continuing downward, price begins moving inside a range. Now, if this sideways range eventually breaks to the upside, we call it an accumulation phase. Take a look at another example. Price moves down, and after the downtrend, it starts creating a sideways range. Now here's an important question. Can we call this an accumulation phase just because we see a range? The answer is no, because from this range, price can move either upward or downward. Until the range is broken to the upside, we cannot confidently say that it was an accumulation phase. On the chart, we first had a downtrend. Then price started moving sideways. At this stage, we simply wait. We don't predict whether the market will go up or down. We wait for confirmation. Once price breaks above the resistance level, we can say that the range was an accumulation phase, because now we have confirmation that buyers have become active in the market. And generally, after an accumulation phase, the market tends to move higher. Now, when the market starts moving upward after accumulation, that movement is called the advance phase. Some traders also call it the markup phase, but advance phase is usually easier to remember. In simple words, the bullish trend that starts after accumulation is known as the advance phase. During this phase, the market creates higher highs and higher lows, and buyers remain in control. Now let's say the market has been moving upward in an advance phase and has already made a strong bullish move. After some time, price starts moving sideways again and creates another range. At this point, there are two possibilities. The first possibility is that price breaks below the range. The second possibility is that price breaks above the range. If the breakout happens to the upside, this range is called a reaccumulation phase. Reaccumulation simply means that buyers are still strong. The market is taking a small pause, collecting liquidity, and preparing for another move higher. But remember, just seeing a range is not enough to call it reaccumulation. A reaccumulation phase is confirmed only when price breaks above the resistance level. Just like we needed confirmation in the accumulation phase, we need confirmation here as well. Once the breakout occurs, the market can continue moving higher and enter another advance phase. Now let's move to the opposite side of the market cycle. Imagine the market has already moved significantly higher and buyers have made good profits. Gradually, these buyers begin booking profits. And remember, when buyers book profits, they close their buy positions, which creates sell orders. As buyers start exiting and new buyers are not entering aggressively, price once again begins moving sideways and forms a range. Now the same rule applies here. We cannot call it a distribution phase just because we see a range. Distribution is confirmed only when price breaks below the range. Once that breakdown occurs, it signals that sellers are getting control and the bullish trend is becoming weaker. Generally, after a distribution phase, the market starts moving downward, and when the market begins falling after distribution, that movement is called the decline phase. This phase is the exact opposite of the advance phase. During the decline phase, the market creates lower highs and lower lows, and sellers remain in control. Now let's say the market is already in a decline phase. After moving lower, price starts moving sideways again and creates another range. If this range breaks downward, it is called a redistribution phase. Redistribution means sellers are still strong and the market is preparing for another bearish move. After the breakdown, the market can continue its decline phase. However, if the same range breaks upward instead of downward, the market cycle may start changing. In that case, the range can eventually become an accumulation phase. This is how the market keeps moving in cycles. Accumulation leads to advance. Advance leads to reaccumulation. Reaccumulation can lead to another advance. Similarly, distribution leads to decline. Decline leads to redistribution, and redistribution can lead to another decline. Now let's discuss the most important part. How can we use market phases for trading? First of all, never take trades directly on a breakout or breakdown. Always wait for confirmation and a retest. For example, suppose the market is in a downtrend. Then a range forms. After that, price breaks above the resistance level. This tells us that the accumulation phase has been confirmed. At this point, we start looking for buying opportunities. But we should not buy immediately after the breakout. Instead, we wait for price to come back and retest the breakout area. If we get a bullish candlestick pattern or any strong bullish confirmation near the retest zone, we can consider entering a buy trade. Our stop loss should be placed below the support level, and our first target should ideally provide at least a 1-to-2 risk-to-reward ratio. The remaining position can be managed using a trailing stop loss. Now imagine the market is already moving in an advanced phase. Then another range forms and price breaks upward once again. This indicates a reaccumulation phase. In such a situation, traders can consider holding their profits because the market is still maintaining a bullish structure. Sometimes the market forms one reaccumulation phase, sometimes it forms two, sometimes three or even four, and sometimes there may not be any reaccumulation at all. The market may move directly from accumulation to distribution. That is why we should never make assumptions. We should only follow what the chart is confirming. For example, if the market forms a range after an advanced phase, but this time it breaks downward instead of upward, then that range becomes a distribution phase. In this situation, traders should start thinking about protecting profits or exiting buy positions. If you entered a trade during the accumulation phase and distribution has now started, you can consider closing your position at break-even or securing whatever profit is available. Similarly, after distribution and redistribution, traders should focus on finding selling opportunities. And always remember one important thing. Wait for breakout or breakdown confirmation, wait for a proper retest, and always follow strict risk management. So friends, today we understood market phases in detail. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and don't forget to press the bell icon so you never miss future trading content. Also, let me know in the comments which trading topic you would like to see in the next video. Thanks for watching.